Your portfolio is bleeding thousands because of a single psychological glitch most investors never notice. Professional traders call it the loss aversion trap, and it triggers a chain reaction that forces you to hold onto losing assets long after you should have walked away. You think you are playing it safe, but your own brain is sabotaging your capital. Tonight, we identified the exact moment this trap triggers and how to escape it. Back, grab a cup of water, and let us get into the mechanics of your own brain. Have you ever kept a stock in your portfolio simply because you were down 20% and you felt like you had to wait until it broke even before you could sell? It is a classic human reaction. You are not alone, but that specific line of thinking is costing you your future wealth. This is known as the sunk cost fallacy, and it is a cognitive bias that forces us to value the money we have already lost over the potential of the capital we still have left to invest. Let us start with the easy win: how to identify when you are falling for it. The easiest way to spot this trap is to ask yourself a simple, brutal question. If you had all your money in cash right now, would you buy this specific asset at its current price today? If your answer is no, then you are only holding that position because of the past, not because of the future. A famous experiment by the psychologist Daniel Kahneman showed that humans are wired to feel the pain of a loss twice as intensely as they feel the pleasure of an equivalent gain. This means your brain is actively working against you when it comes to making objective financial decisions. You keep the losing stock because selling it makes the loss real, and your brain wants to avoid that pain at all costs. But the reality is that the loss is already real. Keeping the stock does not erase the past, it just limits your ability to move your remaining capital into a better, more profitable opportunity. Think of a person who bought a theater ticket for $50, only to realize halfway through the movie that it is absolutely terrible. The rational thing to do is leave, save their time, and go do something they actually enjoy. But most people stay for the full 2 hours. Why? Because they feel like they have to get their money's worth. But they cannot get that time back. The $50 is gone the moment the movie starts. The same thing happens in your brokerage account every single day. Does that sound like a familiar pattern to you? If it does, you are starting to see the trap for what it really is. Now, here is where things get interesting, and we move to the level up. You need to learn how to quantify your opportunity cost. This is the second point of our journey, and it requires a bit more focus. Imagine you have $10,000 tied up in a stagnating tech stock that has been flat for 3 years. You tell yourself you are holding it because you have invested so much time and effort researching it. But while that $10,000 is sitting there doing nothing, it is not just staying flat. It is actually costing you the 8% annual return you could be getting in a simple index fund. Over 5 years, that opportunity cost is roughly $4,600. That is not a small amount of money. That is a vacation, a new computer, or a significant contribution to your retirement. You are paying for the privilege of keeping your ego intact by refusing to admit that the investment was a mistake. If you're finding this helpful so far, hit subscribe because the final method I am going to show you is the one that changes the game entirely. Okay, let us get into the final point. Remember how I mentioned there was a way to break this habit that even professional traders struggle to implement? It is called the zero-based review. Every quarter, you should look at every single position in your portfolio as if you just inherited that position in cash today. You look at your holdings, but instead of seeing the cost basis or how much money you are up or down, you see a total dollar amount. Then you ask yourself, if I had this exact cash amount sitting in my account right now, would I buy these stocks again at today's prices? If the answer is no, you sell it immediately. No emotional hesitation. No dwelling on the purchase price from 3 years ago. It sounds simple, but studies on portfolio management have shown that investors who utilize this zero-based review method outperform those who held on to losing positions by an average of 5% annually over a 10-year period. That 5% is the difference between retiring at 60 and retiring at 50. It is massive. Let that sink in for a second. You are letting the fear of acknowledging a past loss dictate your future success. Once you flip the switch and start focusing on where that money can work best for you right now, you stop being a victim of your own past decisions. The market does not care how much you paid for your shares. The market does not care how much time you spent reading those quarterly reports. The market only cares about where the growth is going to happen next. By applying the zero-based review, you are essentially firing yourself as the emotional manager of your portfolio and rehiring yourself as a cold, calculating, rational investor. It is not always easy to hit the sell button on a stock that has burned you, but the relief you feel afterward is worth it. It is the feeling of freedom. You are no longer tethered to a sinking ship. You are free to swim toward the horizon where the real returns are. Think about the last time you stayed in a bad situation just because you had already invested so much into it. Maybe it was a project at work, a renovation on your home, or even a relationship. The logic is the same in every single area of life. We hold on because we want to justify the past. But justifying the past will never secure your future. So there you go. 3 real ways to handle the sunk cost fallacy in your investing. And that final method of doing a zero-based review could literally save you tens of thousands of dollars over the course of your life. It is not just about the math. It is about the discipline to be objective when it counts the most. You now have the tools to stop losing money on bad bets just because you were the one who made the bet in the first place. If you got value from this, share it with someone who is currently holding a losing position and hit subscribe so you do not miss the next deep dive into the psychology of wealth. Next week, I am going to break down how to handle the fear of missing out, or FOMO, when the market seems to be leaving you behind. You will not want to miss that one. Take care and keep your head in the game. You are building your future one rational decision at a time. See you next time.